This is Larry Shavaro with First Associates, and welcome to our fourth webinar in our Marketplace Lending webinar series. Really excited today. We're having many folks log in right now as we speak. We've had an overwhelming response and record registrations for this webinar, which are some really important topics today. We have Jill Gade and Brian Korn to talk about the originating bank charter and regulatory issues, and so we're really excited to have them today. So I'm just going to give another minute or so as we'll allow more people to log on. Okay, and so really excited to have all of these folks on listening to our webinar today. And for Jill and Brian, this is Larry Shavaro at First Associates. I'm our Executive Vice President. First Associates is a 30-year-old loan servicing company. We're celebrating our 30th anniversary this year. Even people think we're fairly new. We did buy the company 70 years ago. First Associates services over 80% of the marketplace lenders and institutional investors who buy those loans. We work with all of the major platforms and institutional groups today. We're going to, quick on the agenda, we're going to review a little bit about the bank origination charter program and with Jill, and then Brian is going to talk about some of the regulatory issues, including a update on Madden versus Midland, which came down yesterday. So Brian's going to share that with us. All of the prior webinars are located on the First Associates website. There's a webinar which was a securitization, basic understanding of securitization, as well as a webinar featuring Chris Johnson from Prospect Capital, who talked about what he looks at in a platform so that they would buy loans. And then we've had also a few new platforms that came on to talk about their strategy. So without further ado, what I'd like to do is turn it over to Jill. And just one last note, at the end of the webinar there is a brief survey, and so would you be kind enough to fill that out? That helps us for future webinars. Jill Gade is the CEO of Cross River Bank. Cross River Bank is one of the leading bank origination charter programs that are out there. Good friends of ours at First Associates and a client we partner with the Cross River folks on many opportunities out there. And so Jill, take it away.
Thank you, Larry, and thank you for inviting us and participating on this webinar. I think it's fairly innovative, and it's apropos to participate in the webinar to talk about technology and banking. So really appreciate the friendship, and hopefully your listeners will get their we're going to pique their interest in the content of the webinar. So just getting into the presentation, first slide. What we do, this is our mission statement. We're a technology-enabled transaction bank. That means that we are intending really to be at the epicenter of the disintermediation phenomenon, which is rapidly becoming a critical bridge between fintech and banking. So in other words, as we know, after the credit crisis of 2008 and also after the de-risking phenomenon, whereby a lot of the large correspondent banks have exited entire markets just because of AML risk or others. So there are some innovators that just stepped in and tried to disintermediate or to unbundle the banking services, banking products that were no longer offered by those large institutions. The problem is that at the end of the day, you still need a bank for the last mile. And that's where a bank like Cross River Bank is trying to play a role in facilitating the transaction, the last mile of the transaction between the consumer and the innovator. There are naturally a lot of issues and hurdles that are comprised by things such as compliance and regulatory environment, AML issues. So the bank, which has naturally a legacy of 200 years of regulations behind it, which is overall an industry that is very heavily regulated, can actually facilitate the bridge between innovation and banking. Next slide, please. So the bank was born in 2008, in June of 2008. I believe we were one of the last charters to be issued by the FDIC back in 2008, and they quasi shut that down until they reopened the process for a couple of banks since then. But we were very fortunate to really squeak in just before the door was closed on new de novo charters. We actually took advantage of the fact that the regulators had a very close pulse on us. For 7 years, we were in de novo status, and that really helped us build up a communication with our regulators, particularly the FDIC and the New Jersey state regulators. And that facilitated the dialogue for sure, and also that enabled us to set up a compliance management system that was adequate to venture into new territories such as marketplace lending and some of the payment processes that we're providing. So naturally, we're an FDIC-insured bank. We believe that we built a stable foundation in commercial and SBA lending, and as well as core deposits, which really basically is that we want to be true to our core competencies as a community bank, because we don't want to shy away from that, because that's the legacy that put us in this position to know enough about compliance, and particularly to build up our CMS, a compliance management system, in order to put us in a position to be able to facilitate those innovators' access to compliance and regulatory environment. We have compliance experts on staff naturally, and we also do have innovators and serial entrepreneurs as part of our ecosystem. We are engaged on a path to combine our expertise in third-party originated loans, and that really began, I would say, back in 2009, when we built a very strong and robust relationship with what is today a phenomenal, successful story, Green Sky Credit, which is based in Atlanta, Georgia. And we were one of the first banks, if not the first actually, on the Home Depot program of third-party originated loans. And we basically capitalized on our expertise in that arena to basically develop our core competencies in both third-party originated loans, in compliance, as well as credit. Next slide, please. The problem statement is that, like we mentioned before, the legacy players such as Chase, Wells Fargo, Western Union, Fidelity, Travelers, in various aspects of the finance universe, they're starting to see other and new entrants, more like innovators such as Digit, SoFi, TransferWise, Wealthfront, and Guevara, or Oscar in the insurance world. So these are not necessarily clients of ours. Some of them are. But this is just to demonstrate that in every single aspect of the financial universe, there is a new entrant that is trying to disrupt the way the establishment and the status quo. And this is what we're trying to tackle. We're trying to facilitate that blue shaded area of new entrants by telling them, do not necessarily shy away from banks. On the contrary, the banks have a lot to offer to you. You may want to compete for the consumers, for the same consumers. However, as a community bank, we could bring a number of facilitators, such as compliance and regulatory environment, and enabled by technology to help you accomplish what you're trying to do. Next slide, please. Which leads us to what we do today. And we have basically three large buckets of activity in our, I would say, technology-enabled transaction banking. Number one is marketplace lending, or lending in general, and that includes natural NPL, crowdfunding, SBA activity, which we actually package loans and sell them in pools as well, a little bit like Live Oak does. And then naturally loan pool sales and securitization, which is one of the nascent and very fast-growing activities of the bank. On the payment side, we do ACH and IATs, So we developed our own rails. We have our own suite of APIs. We basically developed a core on top of a core. So we sit on top of Fiserv, and we develop a series of APIs to connect directly to the payment rails. That enables us to do instant debit, credit and debit naturally, check 21, bill pay, wires. All this is automated, and particularly our instant debit solution is quite novel, and this is a partnership with MasterCard, which has been sold and is being utilized by a lot of innovators today. And then finally, money transfer. Virtual currency is something that we're dabbling into, actually requiring rather wallet or custody or share ledger and then foreign remittance. And this is something that we do particularly with companies like TransferWise. Next slide. So how do we do that? Just 4 core competencies: compliance reviews, technology integrations, I think is a biggie, security audit, naturally, and then ongoing risk monitoring and reporting. So these 4 categories really are the things that we have not created or invented. On the contrary, this is something that I was talking about before, which is the 200 years of legacy compliance baggage and background that the banking industry as a whole is bringing to the table. And we're just capitalizing on that and just trying to become experts of that and applying new technologies to it to facilitate and scale the model. However, this is really our core competence is really anchored in our community banking nature. Next slide, please. So how do we do it? Integrated solution, just to give an idea of some of the technology that we utilize. So if we are going to serve the innovators, we'd better start using technology ourselves. And this is, I think, the big lesson of the disintermediation phenomenon, is the fact that banks are now challenged to utilize technology. And there is technology accessible to banks today that was not accessible 10 years ago, even 5 years ago. For example, mobile banking, online banking, check 21, or a bill pay, or mobile capture. All these services were not accessible to community banks. The majority of those services were provided by large banks or money centers. Today, this is totally accessible to us. And what we're trying to do is that to enhance those capabilities that are being provided to us by companies like Fiserv, FIS, or others, and then to add to those and enhance our compliance review and make it scalable so that instead of doing a sampling of loans, for example, in compliance review or in credit underwriting check, we will actually will be able to do a 100% review of those loans. Clarity is one of the companies that we utilize for advertisement campaign review, IntegriShield in marketing compliance, and then UberView on social media and intelligence and oversight. So these are just a few examples of the multitudes of technologies that we use nowadays. Next slide, please. So now I would like to hand it over to Brian, who I think is better equipped to discuss the regulatory concerns, true lender status, and particularly the next slide, which is the Madden Midland case, which I understand he has some news for us to share.
Thank you, Jill, and great to be speaking to everyone today on the call. The marketplace lending regulatory environment is really interesting. There's a lot of fragmentation within the regulators, and one of the advantages that many of the MPLs have seized upon in developing their business models is the ability to truly navigate within the regulatory environment in a very efficient way that avoids much of the front-on regulation that many regulated financial institutions, securities brokers, and investment advisors do have to deal with. Regulation is a constant in this business, and obviously with the increased scrutiny on marketplace lending and on as the industry grows and develops and gets to be more mainstream, there's going to be more interest in whether there ought to be more regulation, and we obviously continue to follow the story. The main issues with respect to the consumer regulatory space are fair lending issues, which are generally stemming from federal statutes, data security, data privacy, complaints from customers, how customer complaints are established, UDAP, which stands for Unfair Deceptive Practices, and the issues around what we call the true lender issue. One of the issues with respect to marketplace lending is obviously a lot of the structures are fairly new and novel, although they utilize the regulatory architecture that had preceded marketplace lending. So Cross River and others are licensed and chartered banks. They extend loans to borrowers in marketplace lending transactions, but unlike most banks, many of these loans are sold back to the platforms fairly quickly after origination. Some regulators like this model, like the FDIC, for example, which you have a situation where the borrower cannot possibly default during the time period that the loan is on the bank's balance sheet, therefore reducing the risk of bank bailout or taxpayer funds being used to subsidize deposit insurance. On the other hand, principal regulators of banks might take position that if you look at true lending situation for some of these platforms, the lender might in fact be the platform itself and not the bank. There was a case that originated out of the state of New York 2 years ago involving a defaulted credit card receivable called Madden versus Midland. And if we go to the next slide, we can explore this a little bit more. The facts of the case are that a $5,000 credit card receivable, which was originated by Bank of America, later sold to FIS Card Services, and then the card account defaulted and was sold to a collection agency, Midland Funding, which operates out of New York. The interest rate that the bank had charged the account holder had continued to be charged by the collection firm after the loan was sold to the collection firm. A group of plaintiff lawyers developed a class action case that contested the ability of the non-bank collection firm to charge the interest rate that the bank could charge, and unlike all of the past precedents before it, as well as the law in several other appellate circuits, the district court followed the case law and said no, once the loan is originated, it's valid when sold, and once it's sold, it retains the character that it had when the bank held it, and so any future holder of the debt can continue to charge the rate that the bank charged. And that's generally the understood rule. The surprise in this case came when the case was appealed to the Second Circuit Court of Appeals in New York, and the federal court, by 3-0 vote, actually held that once the loan leaves the hands of the bank, that a non-bank entity is not able to export a rate that a bank could charge, and therefore the license that the bank has through the National Bank Act to charge a rate that would exceed the state usury cap falls off, and the credit, in this case the new holder, the collection agency, has to charge a rate that doesn't exceed the state usury cap. The case has been appealed to first there was a threat to overturn the case in the circuit court itself. The case itself was appealed to the U.S. Supreme Court through something called the writ of certiorari. Most cases that are appealed to the U.S. Supreme Court are not heard for review. The court recently, on January 8th, so along with the appellate brief, there were briefs from the American Bar Association, the Structured Finance Credit Association, a number of other sources that lend credence that this is an important case and that ought to be resolved, and the court should hear the case and should reverse the case. On January 8th, the court, rather than what we kind of expected, which is that they would affirm the ruling of the Second Circuit, instead asked the respondents to file a brief. And the significance of this is that it indicates that the court is taking a closer look at the case than might be expected. And usually when the Supreme Court asks the respondents, so these are the winners in the lower court, the Madden people, to file a reply brief, it means that they want to hear both sides of the story, which lends us to think that there's a greater than 50% chance now that the case will be heard. Now, there's no guarantee that if the court does agree to hear the case, that it will reverse the ruling of the Second Circuit. And in fact, having the case heard in the U.S. Supreme Court might make things more difficult, because if they affirm the Second Circuit, then they've effectively nationalized the Madden precedent. Now, none of this will be resolved in the next week or month, and so what platforms need to think about, and banks who work with platforms, is what can we do to respond to this case in a way that doesn't completely alter or change our business model. And so if you look at this slide on the right, there are several options you have if you're in the business of purchasing loans from a bank that's originated. One, you can do nothing. So the Madden case itself involves the National Bank Act. Many of the marketplace lending platforms actually don't lend under the National Bank Act. They lend under the Federal Deposit Insurance Act and under the parity principle derived from the full faith and credit clause, similar to states that honor out-of-state driver's license. Many states honor bank licenses from other states and allow it to export the legal maximum interest rate that can be charged in the home state of regulation. You can discontinue lending in all the three affected states in the Second Circuit. So the U.S. federal appellate system is divided, I believe, into 12 circuits plus a federal circuit which deals with intellectual property. New York is in the Second Circuit, which includes Connecticut and Vermont. So right now, Madden is the law in New York, Connecticut, and Vermont. It is not the law anywhere else. It is foreseeable that if this case is successful, that other cases will be brought in other areas, but right now we have heard that there is some reluctance, at least on the investor side, to purchase loans that are originated through this case. The flip side, of course, is that when investors buy these loans, many times they want to securitize them, and we've heard that there's friction in pricing concerns in the securitization market on Second Circuit loans. What I think will ultimately happen is that the structure of the lending transactions will change so that a bank is involved further down in the process, and that effectively changes your facts in a way where you have removed the case from Madden being precedential over you. If we go to the next slide. Next slide, please. And the next slide. So a typical marketplace lending structure, just to back up and give everyone context, you have a borrower using a platform would originate the customer, and generally a funding bank would originate the loan in the consumer world. And there's a big distinction between consumer and small business, which we'll get into. The platform is essentially responsible for marketing, origination, licensing, loan custody arrangements, servicing. And I think as a result of Madden, you might see a little bit more of these bullet point duties of the platform shift to the funding bank. That's another way that your facts will differ from the Madden facts. The loans, once they are originated, generally are sold back to the platform after a certain period of time, and then one of several things will happen. The loans could be sold directly to investors who purchase these loans. The loan could be sold to a special purpose entity, which might issue payment-dependent notes. So that's a note that is reliant on the payment from the underlying borrower. This is what you see in Lending Club and Prosper, for example, on their marketplace platform. You could have a loan sold to a fund. You could have one-off investors, as we discussed. You could have the loan sit on the platform balance sheet, and participations are sold to one or all of these three types of categories. If we go to the next slide. So as we highlighted in the beginning, there's been a huge rush of new platforms, service providers, originators, and investors who are really looking to take advantage of this space. I'll leave this for you to review, but there are three main verticals in marketplace lending: consumer, small business, and real estate. And many of the investors have developed protocols for buying multiple loans through on a rapid-fire basis through automatic means. And I think that's really what's driven a lot of this new business. We go to the next slide. So the regulatory landscape, as I mentioned, is divided roughly between consumer and small business. Consumer is largely federally regulated. Its principal means of regulation are statutes, such as the ones below under key guidance. The key players are the federal regulators. Contrast that with small business and real estate, where it is generally a licensing and a state-by-state authority regulation with case law, and your guidance is really state statutes and going state to state. And many of the small business issuers, such as OnDeck and Cabbage, rely on a state system, whereas the consumer lenders are generally relying through their banking partners on the federal system. If we go to the next slide, I've highlighted also within the payment-dependent model, there are various varieties now. In effect, Title III crowdfunding, which will go into effect in May, a new system called Regulation A+, where you can raise up to $50 million without going through an SEC registration, and then what most of the marketplace lenders sell using on payment-dependent notes, Rule 506, or what people call Reg D transactions. So with that, I'll send it back to Larry, who will leave us with some Q&A.
Yes, and thanks, Brian and Jill. That was really good information, and the slides are very well informed. Please continue to send your questions. We're getting quite a few in, and you'll see that you can click on the link for the questions here. So the first question came in was in regards to use of technology, and this is for Jill. It's really interesting today that I'm going to elaborate on the question. There's many banks and there's many ancillary folks, whether it's custodial work, loan origination platforms, us as a servicer, that have not adapted to the technology. I kind of talk about how could you be in the fintech space and not be a technology player, and so that's why we've managed to take most of the share here. But Jill, if we're going to enable technology and innovation to bring products to the market, shouldn't the banks be prepared again to use the technology to adapt to the regulatory changes and realities?
Absolutely, and I think, Larry, you're really pointing the finger at probably one of the hottest buttons in the banking industry today. I mean, the amount of queries or emails that we're getting from FinCEN or the FDIC regarding cybersecurity is enormous compared to anything else. And this is a real worry naturally of the regulators, because we're the holders of a tremendous amount of brain trust, which is the data of the consumers. The problem is that you're this dichotomy between the use of technology and at the same time being more exposed as you use technology to cybercrime. So basically what's going to happen is that with the use of technology, we need to be better prepared in protecting ourselves, which basically means that you're going to be using a lot more technology. So it's like an exponential, it's like a vicious circle of technology engenders technology. But at the end of the day, the banks, I think, are going to be facing the reality of having to be rated on the technology front exactly the same way as a technology company, such as PSI audits, and as well as being ISO compliant, or even in SAS 70 or SSAE 16 compliance, which could even be something to consider for some of those banks. So if you want to play that game. So
that's true, because most of the folks are not SSAE 16 compliant, and you really need that as a ticket to play today. And so,
that's right.
So we agree. Brian, here's a question that came from the audience for you. It says, Brian, we're a small business lending platform. What's the differences between the consumer and small business lending?
Well, as we touched on before, consumer lending is very prescriptive. It's very rules-based, intensive. there's very little latitude for mistakes, and you really need to have a robust compliance program to comply with Truth in Lending Act, Fair Credit Reporting Act, uh, all of the disclosure issues around adverse actions and CFPB directives. Small business lending is really much more of an open system. There are 5 states that absolutely require you to have a license to lend in those states. Many of the other ones do not require a license, but you may get a license in order to increase your usury cap or to allow you to lend below certain levels. Believe it or not, the license is to lend less than a certain amount, and many states have lighter regulations as you go higher up in the principal amount. But those are the principal differences. It's really the everything's allowed unless it's not version versus consumer, which is kind of the opposite.
Perfect. Thank you. We got a dozen questions that came in regarding the slides, and yes, later today the slide deck will be sent out to the folks with a link for the recording on the webinar as well. We're going to have one more question, but I do want to remind you to please, when the webinar is over in a couple minutes, to take a minute and fill out the survey for us. Now, the last question I have both for Jill and Brian. I'll start with Jill. What are your predictions? What do you see for 2016 in the market?
In the NPA market particularly?
Yes.
I would say we're going to see, what we're seeing is that there are a lot of new entrants naturally, but are more like legacy players. To name one is Loan Depot. I believe that we're going to see a lot more in 2016 that are paying attention to this industry. For them, it's a perfect way to originate a new source of loans and to capitalize on the existing clientele. It's just to lower the cost of acquisition of consumers. They can compete probably very well with what we're going to call the legacy players, which really are innovators like Lending Club and Prosper. So I think we're going to see a lot more of those. Number two, I think that we're going to see a lot more skin in the game, both from the banks originating, and that includes us, and we really welcome that because we've been big proponents of that for the past 2 years now, as well as from the platforms themselves. And we are seeing all the platforms gearing up to prepare their balance sheet to accept loans on them. So these are my 2 takeaways for 2016.
Thank you.
Yeah, I think that I think you're going to see a lot more of the old banking world trying to catch up and get in on the learning curve here. Similar to JP Morgan and OnDeck announcements, I think you'll see more and more bank partnerships, primarily driven by banks that are afraid that they might miss out on sort of the new paradigm of future lending. And certainly with respect to a lot of these sectors, online lending is going to far outpace offline lending for the foreseeable future and possibly forever. Regulation is a little bit more tricky and nuanced, and I think that there'll be a lot more attention. I think that you're going to continue to see interest from Treasury. There might be formal recommendations that come out of the Treasury request for information process that happened late last year, and I think that unfortunately, we're going to be driven by a few unfortunate cases in how they wind their way through the court system, and then, as with any case, barring a regulator specifically saying this case applies to you, you no longer can do this, it's really going to be up to the banks and the platforms and the legal professionals to determine whether the facts of a certain situation match the facts of a case enough where it's likely that somebody else could succeed in a lawsuit against you. And so I'm not trying to promote legal services or anything like that. I mean, of course I am, but I really think that there'll be a lot more bespoke regulatory consulting that comes out of the current environment, because there's a lot of efficiencies in marketplace lending, and a lot of the laws and the rules that we have on the books are somewhat antiquated, are based on telephone and mail, and as you see regulation catch up, you're going to see more situations. There'll also be a handful, I think, of bad actors who are taken to task for situations that everyone will obviously agree are improper, and hopefully that won't taint the rest of the industry.
Well, great. Brian and Jill, thank you so much for your insight today. That will conclude our webinar in our Marketplace Lending series. Please be on the lookout for additional webinars that will take place in the upcoming months, and I'm sure we'll see most of the folks at the conference circuit. Thanks for listening in today.